The fund seeks to deliver long-term capital appreciation above inflation, based on active and flexible management of a portfolio, predominantly comprised of equities and complemented by relatively decorrelated fixed income investments. In order to deliver our objective, the team as a whole aims to invest primarily in growing companies with rare track records of success and value creation, seize opportunities to reinvest in such companies when valuations drop, and augment the fund's profile by holding a complementary and variable amount of decorrelated fixed income securities. By focusing on selecting shares of these quality growth companies, combined with a pocket of defensive fixed income investments, we have the ability to adjust the overall exposure to each asset class, and it enables us to effectively focus on long-term value creation in a risk-conscious manner.
The notion of market timing is an important one to the fund's actual DNA. It relates to a central principle of not only my father Eric Sturdza and his approximately 50 years of market experience, but also to the accumulated experience of the entire team. And we truly strongly believe that it is virtually impossible to time the market in a consistent and accurate fashion, if you will. There wouldn't be a market in the first place. So, to the contrary, investing successfully is often attained by patience and an ability to seize opportunities when they present themselves. Concretely, it means remaining invested at all times in companies that can continue to grow in the long term, while keeping reserves on the sidelines to reinvest in times of widespread nervousness or even fear. The fund has been designed with this principle in mind. And instead of focusing on trying to anticipate short-term market movements, we chose to be significantly invested in equities at all times, between 51 and 80%, but allocate a certain percentage of the fund to more defensive fixed income assets, which will generate stability and relative performance in times of market reversals. This provides us with the resources and the ability to seize investment opportunities which materialize in such scenarios. The responsibility of the overall asset allocation committee is therefore not to time the markets, but to judge with some perspective how attractive an investment or our investments are, and how much reserves should be set aside to be used should markets, let's say, retreat sharply.
The selection process is a function of the fund's overall objective, which is to generate long-term capital growth, primarily by identifying companies that have demonstrated an ability to grow at a superior rate to their peers in a stable fashion, and invest in those that are undervalued by the market. In order to identify these companies and then find those that are worth investing in, we work with different tools and we have various steps in the process. To be more concise, we first rely on screening to focus our attention on the most promising universe we can create, and then spend time on understanding the companies to construct an attractive, diversified portfolio from this initially filtered universe. For example, some of the screening criteria include size, region, and ability to get quality information, but also profitability, consistency, indebtedness, historical growth, and valuation. At the end of the identification process, we seek to have a collection of companies that are quite unique in their ability and track record to grow, and therefore continue to create value. We especially value those that are able to do so relatively independently of the economy, being exposed to stable underlying growth themes, and providing their clients with superior offerings. And last but not least, we want to be able to form a reasonable opinion on their ability to continue to grow in a relatively stable manner. Portfolio construction is then the last step, seeking to take not just the most attractive investments, but also ensuring diversification, not just from a sector standpoint, but also from a fundamental growth driver and market sensitivity standpoint.
Given the fund's philosophy, investment objective and structure, the purpose of fixed income assets in the overall allocation is to have a diversifying set of exposures, returning low but positive returns above inflation over time. In times of equity market stress or turmoil, the role of fixed income investments selected is and will be to provide a source of stability versus equities and be a source of profit-taking to reinvest in what we believe to be the most attractive set of equities. In other words, we seek to capture the opportunity a recession offers to average equity entry prices and enhance the most powerful factor in long-term investments, the power of compounding returns. Concretely, it implies that fixed income investments are especially focused on what we believe are the least correlated securities to global equities. In certain situations, possibly meaning longer duration than typical fixed income funds, and a tendency to remain in low credit risk instruments. Structurally set at a minimum of 20%, the allocation to fixed income can go up to 49% in times of maximum cautiousness of the allocation committee towards equities and risk perceived.
Short and long-term investors have a lot of similarities, but their main difference is their relationship to volatility. Short-term return targets see volatility as their main enemy, and by definition, they depend heavily on timing and foresight. On the contrary, for long-term investors, volatility acts as an ally, enabling them to invest and reinvest during drawdowns when valuations are inexpensive and projections are dimmed. And by doing so, they let the forces of GDP growth, innovation, and mean reversion work on their behalf. Over the long term, even modest reinvestments at attractive valuation can have a significant impact on these compounded returns. And by understanding the importance of these reinvestments, volatility truly becomes an opportunity. And with this, the importance of structuring the Sturdza Family Fund in the way that we did becomes very clear. Have two decorrelated asset classes with variable weights benefiting from the ability to harness market volatility as an opportunity to buy. So risk is obviously a key component of what we do. As mentioned previously, we address risk at various levels, and there are various types of risks. So let me just tell you a little bit about how we do it for the Sturdza Family Fund. First, the initial idea behind the very creation of the fund. We want to have two asset classes that are decorrelated and therefore reduce overall volatility. Secondly, at the individual asset class level, risk is addressed in many and various ways. For example, and firstly, it's about concentration. Inside the equity portfolio, we have a number of positions from 50 to 60 positions with the ability to go up to 100 if needed, and that enables us to have low concentration of risk in one specific idea. Again, for example, the second part is that we're diversified across sectors. So while there are sectors of the economy where we are less involved with due to the fact that we see, relatively speaking, higher stable growth companies, we have to address diversification in a more granular fashion with the sectors that we're exposed to. So for example, we're diversified across healthcare, technology, consumer staples, different sectors of the economy, but also at a more granular level, we are diversified within those sectors via subsectors and underlying theme exposures.
We address risk at different levels. At the overall allocation level, the philosophy of the fund is to combine two asset classes with decorrelating characteristics, equity and bonds, in a way that enables us to offer clients an investment vehicle with a reduced overall volatility profile. This allows the team to use market drawdown as an opportunity to reinvest and offer a more stable and superior return profile over long periods of time. At the individual asset class level, in an equity portfolio, we reduce idiosyncratic risk by holding 50 to potentially 100 positions. Furthermore, we are diversified across geographies, sectors, and holding companies exposed to different underlying terms. A key ingredient of risk management for us is to understand these companies in detail, their strategies, their sensitivities, and whether we are dependent in our portfolio on too narrow number of factors to drive future performance. In fixed income, there are two aspects we monitor closely: credit risk and liquidity risk. While our process naturally focuses on government bonds, credit scoring model and liquidity risk analysis are used to assess the characteristic of any fixed income securities entering the portfolio. Deeply ingrained in the fund DNAs is the objective to provide an attractive risk-adjusted return profile and to harness risk to our shareholders' benefit.